Hello, everyone. I want to talk about Chapter 9, and this is going to be the chapter on plant assets, natural resources, and some intangibles. Now, this chapter is really going to primarily focus on many of the long-term assets that are on the balance sheet. So we're getting close to the bottom of the balance sheet. So again, we're going to look at fixed assets or property, plant, and equipment, and land, also called plant assets. We'll take a look at some accounting for natural resources. So if you've got maybe timber or oil out there and you go out and buy a plot of timber that say maybe has 10,000 trees on it, we want to figure out what type of allocation we're going to be using if we do have natural resources. And then we'll take a look at intangible assets, meaning these are assets out there that have no physical form, but you need them in order to run your business. And that could be like patents and copyrights and trademarks. So we'll talk further about this also. So let's move on. Let's talk about measuring the cost of property, plant, and equipment. Now, when we look at property, plant, and equipment, we're looking at historic cost or the amount it costs in order to get the asset in your possession and up and running. Now, with property, plant, and equipment, what it is long-lived tangible assets. Now, these are assets out there that you're definitely going to use in the operation of your business. And the thing is with long-lived tangible assets, these are assets out here that are going to last a lot longer than a one-year time period. Now, you really have to watch when you're buying these long-lived assets. Why? Because there's a lot of money. They are a lot of money, and also you want to make sure that you're spending that money wisely so you're getting a good bang or you're getting a good return on your investment. Now, some property, plant, and equipment. And with property, plant, and equipment, this name could be interchanged between, say, fixed assets, property, plant, and equipment, or long-lived tangible assets. I've seen it listed as that also. But apparently this book likes to use property, plant, and equipment, and that's fine too. Now, some examples of long-lived tangible assets: land all the way. Land is something that is very tangible, and obviously you could step on it and so on. Buildings, equipment, furniture, fixtures, automobiles. Again, these are all assets that you need in order to run your business. But the problem is they're going to last a very long time out there. Now, what about plant assets? Now, plant assets are long-term. They're definitely going to last several years. The other thing we're going to be taking a look at also in this chapter, and it's going to be a little bit different. Now, back in Chapter 3, I believe, when we talked about adjusting entries, we did talk about depreciation expense and how we would book the corresponding credit to accumulated depreciation. Now, the cost of an asset normally is allocated to an expense over the years that the asset is expected to be used. Now, we're going to be booking a part of that asset to an expense account. The other thing is we're not going to be booking the credit as a credit to, say, the equipment account or a credit to buildings or fixtures or whatever. We're going to be booking the depreciation expense to a contra account called accumulated depreciation. Now, just remember that the allocation of a plant's asset cost over its useful life is called depreciation, and it's going to follow the matching principle of matching revenues and expenses together. Now, with the life cycle of a plant asset, really what we're looking here is we're actually going to go out and buy the asset or acquire it. And number one, we use the asset and then we'll dispose of it. Because after a while, say after we're done using it, we might not be able to get any more value out of this asset, so we could turn around and get rid of it or dispose of that asset. Now, normally with a plant asset, it's going to be paid at historical cost. Okay, so we're not going to be looking at fair market value or increasing the plant asset up to its fair market value or anything like that. We're just going to be basing that plant asset purchase on its historical cost. So again, this is definitely going to follow the GAAP principle out there of looking at the cost principle, and we're going to be purchasing those assets at their actual costs. Now, the actual cost of an asset, of a property, plant, and equipment asset, is definitely the purchase price plus any costs out there in order to get that asset ready for use. Now, what does that mean? Well, say for land and improvements, you're definitely going to have the purchase price out there. No question about that. Now, there's also going to be some other costs out there in purchasing land. You've got perhaps some brokerage commission, legal and survey and legal fees, where you're going to have the appraiser or the title person come out and make sure that that land is properly measured. So you've got surveys. You also might have some delinquent property taxes out there that you might have to pay, title transfer fees, and if the land has, if you're buying that land for the location, you may have some excavation on the land or may have to clear the land a bit. So again, these are all costs that we're going to be adding to the cost of land. Now, cost of land does not include, say, fencing, paving, lighting, signs, sprinkler systems. These are called land improvements. We're actually going to be improving the land, and with land improvements, normally those are subject to depreciation. Now, regular land is never subject to depreciation because, in all honesty, land never depreciates in value. It always appreciates in value. So there again, the cost of land the land value, we're never going to depreciate land. However, if there are land improvements like fencing and paving and so on, we will definitely depreciate those assets. Now let's take a look here. Now we're going to take a look at measuring the cost of land. Now, Smart Touch went ahead and purchased land on August 1st for $50,000 with a note payable. Now, other costs included $4,000 in delinquent property taxes, $2,000 in transfer taxes, $5,000 to remove an old building, and a $1,000 survey fee. So really what we've got going on out here is we've got some additional costs to acquire the land. So we've got property taxes, transfer taxes, and removal of the building and a survey fee. So that totals about $12,000 altogether. So again, we want to add those costs to the purchase price of the land of $50,000. So my total cost of the land that I'm going to have on my books is $62,000. So again, when we're looking at creating a journal entry to record that transaction for the land, we're going to make a debit to land of $62,000, a credit to a notes payable of $50,000 because we're paying for that land with a note, and then the other $12,000 we're going to pay with cash. So again, we bought the land for $50,000 with a note. Everything else for the land we spent cash in order to get that. Now, we're going to capitalize, or meaning we're going to put the cost of land as an asset value. So again, capitalize means that an asset account was debited, increased because the company acquired an asset. So that's what we mean when you hear the term capitalizing the balance. We're going to make it into an asset. So in this case, for the land improvements that were out there, Smart Touch paid $20,000 for fences, paving, lighting, and signs on August 15th. In this case here, we're going to make a debit to land improvements of $20,000 and a credit to cash of $20,000. Now, just remember, land we don't depreciate, but land improvements we will depreciate because there's two separate asset classes. Now, let's take a look at buildings. Now, on the building side, there's two things we can do when we get a building. Number one, we can construct a building, or number two, we can purchase an existing building. Now, if we're going to construct a building, what we're going to have here is architect fees, building permits, contractor charges, and payments for material, labor, and miscellaneous costs. That goes into constructing a building. If we actually purchase a building, what we really have out there is the purchase price of the building that we're going to buy, and then any cost to renovate the building for use. Okay? So again, with purchasing an existing building, it's going to be the actual purchase price of the building plus any costs, any associated costs to get it up and running or get it into usable condition. Or we can construct a building where we've got materials, labor, and miscellaneous costs out there in order to construct a building. Now, machinery and equipment, when we're looking at equipment here, again, we're talking purchase price less any discounts that we might be getting if we buy this piece of equipment. Then we've got any transportation, insurance, sales tax, purchase commission, install costs, testing costs. These are all costs out there we need to add to the cost of the asset, because those are the costs out there. We need to get it up and in usable and in running order. So again, those costs here are going to be added to the actual cost of machinery and equipment. Furniture and fixtures, again, these are your desks, chairs, and so on and so forth. Anything you need, for your administrative building, or at least to provide a seat for workers and things like that, or a desk area. Now, the cost of furniture, again, the purchase price less any discounts that are taken, and then any costs are ready to get the asset for its intended use. So if I've decided, or if I've learned in the teaching magazines that are out there, that live piano music provides a soothing environment for the students in the classroom environment. So I decide, you know what, for my business, for my one classroom business, I'm going to buy a piano. Now, I go out and buy that grand piano, but the problem is I can't get that piano through the doorway. So what I'm going to have to do is take out the whole doorway to make sure I have enough room to get the piano in. I'll take out the whole doorway. Once I get the piano in, we'll put the doorway back. The costs of removing and reinstalling the doorway will be added to the cost of the piano, added to the cost of the asset. So just know that all other costs to get the asset to its intended use will be added to the cost of the asset. Now, capital and revenue expenditures, we're looking here, when we look at these type of expenditures, what are they? Now, capital expenditures are going to be used to increase the asset's useful life, and these can include extraordinary repairs. Now, revenue expenditures, these are ordinarily incurred to maintain the asset in working order. Now, difference between revenue and capital expenditures. Here's one right off the bat. Now, back about, originally I was driving a 2008 Acura TL, and I've got this car, and all three of my kids are going to be going to college. Now, I'm not going to be able to afford a car for at least 4 or 5 years, okay, or an actual new car or anything like that, or I won't be able to put out the money for quite a long time period. But I'm reading in this article or this magazine that there is a special engine out there that will last 500,000 miles. Now, an Acura's engine might be 150 to 200,000. So I'm looking at that engine going, I love my car. If I put this engine in, this is going to make the car run till 500,000 miles. You know what? I want to buy this. And the cost of the engine is $8,000. Now, that right there, as soon as I buy that new engine and drop it into the Acura, that's going to be a capital expenditure. Why? Because it's going to increase the Acura's useful life. It's going to go for a longer time period than, say, the original engine would have. Now, that's considered a capital expenditure. Now, a revenue expenditure in this case would be your normal oil changes, tires, new tires, anything to keep the car in working order. That would be considered a revenue expenditure, and those expenses would be matched up against the revenues. So in this case here, spending $3,000 to rebuild the engine of a 5-year-old truck is an extraordinary repair because it extends the asset's life past its normal expected life. So in this case here, we're going to actually, instead of booking it to an expense, we'll make sure that we debit the actual truck account, and then we'll credit cash because, again, that's the cost of rebuilding the engine on the truck, and it's going to extend the useful life, the life of the truck. Now, in this case here, Smart Touch paid $500 cash to repair or replace tires on the truck. Now, an expenditure like this doesn't extend the useful life of the truck or increase its efficiency. So in this case here, that would be a revenue expenditure. So again, I'm going to make the debit to repairs and maintenance expense, and then credit cash for that amount also, for the $500. So remember, with capital and revenue expenditures, capital expenditures, we're always going to debit the asset account. And again, these are major improvements to the item or extraordinary repairs. It's anything that increases the useful life. Then on the revenue expenditure side, again, these are the normal repairs like oil changes and tire rotation and things like that. And we'll just expense those. So the first question is, which of the following is included in the cost of a plant asset? Is it A, the amounts paid to make the asset ready for its intended use? Is it B, regular repair and maintenance cost? Is it C, replacement of damaged parts of the asset? Or D, wages of workers who use the asset in normal operations? Well, to me on this one, number one, A is the answer that really stands out here, and that's going to be the amounts paid to make the asset ready for its intended use. So this one is A. Number two, Masonry Construction Group paid $10,000 for a plant asset that had a market value of $14,500. And which of the following amounts should the plant asset be recorded? Well, this one here, the plant asset should always be recorded at the cost you paid for it. So in this case here, it's $10,000. This is answer C. Number three, Danube Corp purchased a used machinery for $21,000. The machinery required install costs of $6,000 and insurance while in transit of $1,800. At which of the following amounts would the machine be recorded? Well, definitely, let's go to the answer on this one. Definitely, it's going to be the cost of the machine at $21,000. It's going to be the required install costs of $6,000, so that's $27,000. And this would also be the insurance also with that. So the cost of the machinery here is going to be $28,800. Answer is D. Number four, Freeman Inc. owns a delivery truck. Which of the following costs associated with the truck will be capitalized and depreciated? Modification for new use, A. Is it B, oil change and lubrication? Is it C, replacement of tires? Or is it D, normal engine repair? Well, B, C, and D are all revenue expenditures, which are expenses out there in order to keep the asset up and running. A is truly the one out there that we should really add as capitalized and be depreciated on. Correct answer is A. And then classify each of the following expenditures as capital or revenue expenditure. The repair of transmission or engine, this one is a repair expenditure. Sales tax price paid on purchase price, that's a good one. On the purchase price, that's going to be a capital expenditure. Now, training of personnel for the initial operation of machinery, that could also, I'd like capital on that one. And then number four, modification for new use, this one's capital. So what I'm assuming here is one is a revenue expenditure, and 2, 3, and 4 are all capital expenditures. So let's move on.